If you've ever been interested in or wanted to invest, you've probably heard of a whole heap of confusing phrases like index funds, bonds, equities, and all of that. But in this video, we're due to go back to complete basics, and I'll be telling you not only why you should be investing, but at the end, I'll also be telling you exactly how you can get started investing. Wagwarn people, welcome back. For those of you who don't already know, my name is Benji, and here I aim to help you make more bread by sharing my own struggles, experiences, and advice. So this video is all about why you need to be investing and why just keeping money sat around is not a good thing. Alright, so why should you invest? Well, let me ask you a little quick question. Do you want your money to be going down in value? If your answer is no, then that's exactly why you need to be investing. Now you might be thinking, yo Benji, why is my money going down in value? Well, the answer is inflation. In its simplest terms, inflation is our money going down in value over time due to the increasing cost of goods and services. Our bread is literally able to afford and buy less in the future than it is today. Currently, the highest interest rate bank accounts give under a 1% interest rate, but the target inflation rate, that's 2%. That means on average that the cost of items of goods and services is going up by 2% a year. Your bread is only increased in value by under 1% a year, but the cost of goods and services is targeted to go up at 2% per year. Your bread is literally becoming worth less and less every single year due to inflation. You are literally becoming less wealthy by doing nothing. And that's why you need to invest in things that are able to consistently beat the inflation rate. But now you know that you do need to be investing, the question is, what can I invest in? These things are usually talked about as 5 different asset classes, and in this video I am going to be talking you through them all from the least risky up until the riskiest. The first asset class is cash. Now this one is just self-explanatory. It's the bread that you have in the bank or in your wallet or underneath your mattress or in your walls if you're on that dodgy stuff. Cash is the most liquid of all asset classes, but as we've already deciphered, cash loses its value over time. So long story short, it's not good to have hella cash just laying around doing nothing, which brings me on to asset class number 2, bonds. Bonds are just loans reversed. So whenever you need some bread, some extra bread, you can go to a bank or to a loan shark, which you should never do, by the way, but you can go there, and you borrow some money, and the cost of borrowing this money is the interest rate. Now with bonds, what you are doing is you are lending out money and in return receiving an interest rate. There are typically 2 main types of bonds that are issued: government bonds from government organizations and corporate bonds from companies. Now bonds are typically low risk, low reward investments. This is due to things like governments not being expected to default on their loans. However, we have seen in the past that this has happened with countries like Greece. So it is important to choose the right type of bond for you, as there are ones with different risk levels, and you can check out a different bond's risk level through checking their credit rating. I personally don't invest in any bonds as I like a little bit more risk, but it is important if you are going to invest in bonds to choose the right ones for your goals. The next asset class is commodities. These include things like gold and silver. Now in the past, these were one of the go-tos for investing your money, and still to this day are often used as signs of wealth. This is due to the fact that they are scarce resources and therefore hold their value and increase in value over time. Going back to basic economics, the college school stuff. If there's a slow supply and at least a consistent demand, price will rise over time. The 4th asset class is the one I want to invest into properly next, and it's property. Now technically I am already kind of investing into property, as I will talk about how very soon, but there is many ways to make money off property through things like rental and future resale. But property can be hella expensive and have mad high barriers to entry, and so it can be difficult to get onto the property ladder and start making money from these investments. There are other ways to invest in property though, and these are through REITs, also known as real estate investment trusts, and I own some of these, which means I am actually technically invested into property. Some of my favourite REITs include Realty Income, who also pay me a monthly dividend, as we will talk about next. The purpose of a REIT is to generate profit from its property portfolio and then return it to shareholders. And this brings me on to asset class number 5, stocks. This is currently my favourite asset class now. It might be property in the future, who knows, but it's currently my favourite and it's one of the most popular out there. When you buy stocks, what you are actually doing is buying a small or large proportion of a company. Now, obviously, if you just invest in a couple of £100, then it's not going to be a large percentage at all. But people out there like Warren Buffett I think he owns like 5% of Apple through his stocks. Now, there are a couple ways to make money off these companies that you own a part of. And the first one is just if the company performs well and the stock price increases. This can happen if they've made good profits over a quarter or a year, or if there's been new product announcements that people are really excited about. There are so many factors influencing the price of the stock, but once again, going back to the basic economics, if the supply of shares stays the same, so the amount of shares available stays the same, and the demand for those shares goes up, then the stock price will rise. The difference between the price you bought at or your average price and the current price of the stock is your paper profit or loss. The next way to make bread from stocks is through dividends. Now, not all companies offer a dividend, but large reputable ones like Apple and McDonald's do. I've done full videos on dividends and dividend stocks, including some of my favorites, because as you know, I love my dividend stocks. So be sure to check out those videos if you haven't already. But in its most simple terms, a dividend is just a distribution of a company's profits to its shareholders. Different companies pay dividends at different rates and at different times, with Apple paying their dividend quarterly, and the prior mentioned one of my favorites, Realty Income, paying their dividend monthly. That means I get paid monthly for owning that stock. But one thing I do stress when investing is it's important to diversify your portfolio. Now, this can be hard. So one of the easiest ways to do this is through index funds. Index funds are simply designed to measure and track the market or a portion of the market. And you've probably heard of some of the largest, most popular ones like the S&P 500 or here in the UK, the FTSE 100. Index funds and ETFs are one of the simplest ways to diversify your portfolio and one of the easiest ways to get started investing overall. It's how I started, and I still have a large percentage of my stock portfolio in index funds and ETFs. So how can you actually start investing? Well, it's important to have met a few criteria before you do get started. The first is to have a 3 to 12 month emergency fund. I've talked about these so many times on this channel, but it is so important that you have one before you start investing. It means that if anything ever goes wrong, if you're ever in need of some quick money, that you do not need to sell out of your investments at a potential loss in order to get some liquid cash. Things always go wrong. Just last week, our dishwasher broke down. We don't know when they're going to go wrong, but they are at some point. So you are always going to need that emergency fund there for just in case. Next is to make sure that you have no high interest debt. This is because more often than not, the amount of interest you are paying on that high interest debt is more than the returns you will be making from the stock market. On top of this, I also always talk about how good compound interest is, but it can also work against you. So it's important to pay off that high interest debt as soon as possible and before you start investing. Finally, is to not be investing any money that you are going to be needing in the next few years. Now, historically, the markets go up, cool, we can all understand that. But in the short term of a few years, we never know whether the markets are going to go up or down. They are pretty volatile. If, for example, you're planning on buying a car or putting a mortgage down on a house, it's not good to put this money into investments in case at the time you are coming to make your purchase, the market is in a bear market, and so you have to sell out at a loss in order to cover the purchase price or the mortgage price. But once you've met all these criteria, understand what you want to invest in, and know your own personal risk level and goals, it's time to get started. For stocks, what you will need is a stockbroker. Now, this is not a complicated process at all. It's as simple as downloading an app on your phone or going to a website on your computer. Different companies have different apps and websites, but here in the UK, I personally use Trading 212 and also have a free trade account. Over in the US, some of the most popular stockbrokers include Webull and Robinhood. If you want to know more about investing, including further in-depth tips on stocks and increasing your net worth, be sure to check out this video. Love to everyone who's watched this far, and we will see you again soon.